Listen to me very carefully, because I'm only going to say this once, and if you ignore what I'm about to tell you, you are going to lose a significant amount of money. Right now, today, as you are watching this video, there are hundreds of thousands of retail investors sitting on gold and silver positions, feeling smug, feeling safe, telling themselves that they are the smart money, that they figured it out, that precious metals are their shield against everything broken in this economy. And I'm here to tell you, with zero apology and zero softening of the blow, that most of those people are wrong. Not slightly wrong, not oops, bad timing wrong. I mean catastrophically account damaging, waking up at 3 a.m. in a cold sweat wrong. The charts do not care about your feelings. The charts do not care about your thesis. The charts do not care that you read 3 books about the gold standard and watch the documentary about the Federal Reserve. The charts are telling you something right now, and what they are saying is not what you want to hear. Gold and silver are setting up for a massive flush, and if you do not know your exact buy levels before that flush happens, you are going to be the person selling at the bottom. I have spent decades in these markets. I have seen this pattern destroy people who thought they were brilliant. Do not be that person. Now, before I go any further, I need you to do one thing, and I need you to do it right now. Before you convince yourself you will do it later, because you will not do it later. Hit that subscribe button. I do not say this because I need the validation. I say this because the level analysis I am about to give you, the specific numbers, the specific zones, the exact price targets on gold, silver, platinum, and palladium, that is information that institutional desks pay thousands of dollars per month to access. You are getting it here right now for free. The only currency I'm asking you to pay me with is a subscription. Hit the button, do it now, then we get to work. Let us start with gold, because gold is where most of the confusion is, and confusion in markets is how ordinary people lose money to people like me. Here is what is happening on the gold chart, and here is what the bulls are refusing to accept. After gold put in a major top, it flushed down hard, and it found support in the 4,300 to 4,400 range. Now, for a brief moment, the bulls got excited. Gold bounced. It came back up toward its highs, and then it failed. It could not reclaim its all-time high. It stalled at what we call the body of the prior move, which in technical terms is your first and most obvious signal of weakness. When a market makes a big move up, gets hit, bounces, and then cannot get back to where it was, that is not a market preparing for a new leg higher. That is a market telling you that the sellers are still in control, that every rally is being sold into, and that the people who bought at or near the highs are looking for an exit. Now I want to explain something to you that every serious trader understands, but that most retail investors never fully internalize. Because if they did, they would make far fewer catastrophic mistakes. It is the principle of resistance becoming support and support becoming resistance. When gold was consolidating for months below a certain price level, that level was resistance. Every time price approached it, sellers showed up and knocked it back down. Then gold broke through that level. It broke out, and here's what the market did next. Here is what it always does. It came back to test that breakout level, and when it did, that former resistance became support. The sellers who had been defending that level were gone. The buyers who missed the initial breakout stepped in right there. That is not a coincidence. That is not luck. That is the structure of markets, and it repeats itself with extraordinary consistency across every asset class I've ever traded. On the gold chart, you can see this principle playing out in real time right now. And that same zone, that former consolidation, that former breakout area, is still acting as a technical floor. But floors do not last forever when the overall trend is pointing down, and that is exactly where we are. The descending channel on gold right now is not subtle. It is not a matter of interpretation. It is not something you need a PhD or a Bloomberg terminal to see. If you connect the significant high pivot to the next significant high pivot and draw your parallel down, you land precisely on the corresponding low pivots. Precisely. That is not an accident. That is the market drawing you a map. And the map says lower highs, lower lows. Descending trend. This is a classic bearish pullback structure inside of a longer-term bull market. And the distinction matters enormously because it determines how you trade it. In the near term, the chart is bearish, full stop. That does not mean gold cannot bounce. Of course it can bounce. Markets do not go straight down any more than they go straight up. but every bounce in the descending channel is a lower high, and every subsequent move down makes a lower low. And if you are sitting there averaging into gold on every little dip thinking you are being smart, you are not being smart. You are being emotional. And the market is going to take your money with ruthless efficiency. Here is the cold mathematical reality of where gold is headed in the near term. And I want you to write these numbers down because vague ideas do not make you money. Specific levels do. The first level of real significance below current prices is 3,900. Now, 3,900 is not an arbitrary number pulled from thin air. It is a prior pivot low on the chart, which means it represents a level where buyers previously stepped in with enough force to stop the decline. That gives it technical significance. And that significance means that when price approaches it again, you'll likely see a reaction, maybe a bounce, maybe a pause, maybe just a slowdown. But here is what most people will do when gold hits 3,900. They will cheer. They will say, see, I told you it would hold. I told you the bull market was intact. And some of them will buy there, and some of those buyers will be right for a period of time. But the real target, the target that actually completes the technical picture, the target that represents what I call the scene of the crime retrace, is 3,500. Let me explain what I mean by scene of the crime, because this is one of the most important concepts in all of technical analysis, and almost nobody outside of professional trading circles talks about it correctly. When gold was trading in a 3,400 to 3,600 range for an extended period, that level was contested. Buyers and sellers fought over it. It was resistance. Multiple times, gold approached that zone and got turned back. Then gold finally broke through it with authority and launched on that spectacular run to all-time highs. Now, here's the problem. It never came back to test that breakout zone. It never returned to the scene of the crime. In technical analysis, when a market breaks out of a major resistance zone and does not retest it, that is unfinished business. The market has a memory. Those old resistance levels, those old contested zones, they do not just disappear from relevance because price moved away from them. They sit there waiting. And eventually, not always, but with a frequency that makes it statistically meaningful, the market comes back to test them. And when it does, they become the strongest support on the entire chart because they represent the last major area where price found balance before the big move. So when I say gold needs to come back to 3,500 before the next truly significant bull run can begin, I am not being pessimistic. I am not bearish on gold. I am telling you that the market needs to do this work. This technical housekeeping before it can build a foundation for the next major leg higher. Now I know what some of you are thinking. You are thinking, but what about currency debasement? What about the Federal Reserve? What about Jerome Powell getting replaced with someone more dovish? What about the US government's debt spiral? And here's my answer to all of that. You are right. Every single one of those macro factors is real. And every single one of them is ultimately bullish for gold in the long term. The US government is not going to stop spending money it does not have. The Federal Reserve is going to eventually capitulate and cut rates aggressively, especially when the political pressure from a more compliant Fed chair becomes overwhelming. These are structural tailwinds for gold that I believe in deeply, but believing in the long-term direction of an asset and knowing the right time to buy that asset are two completely different skills, and conflating them is one of the most expensive mistakes an investor can make. Let me give you the framework I use, because I do not just throw money at things because I believe in the story. I buy at levels where the risk-reward makes mathematical sense. If gold goes to 3,500, which is my primary target for the scene of the crime retrace, and then bottom, somewhere in that 3,500 range, I am buying an asset that I believe will eventually trade at new all-time highs well above 5,000. That is a potential return on a well-timed entry that justifies the patience. If instead you bought gold right now, somewhere in the 4,300 to 4,400 range, and my near-term thesis is correct and it drops to 3,500, you are sitting on a loss of roughly 20 to 25% before you even get to participate in the next bull run. Can you handle that psychologically? Can you handle that financially? Most people cannot, and that is why they sell at exactly the wrong moment and miss the entire recovery. The math of patient investing is not complicated. The emotional discipline required to actually execute patient investing, that is where most people fail. And that failure is entirely predictable. I want to be clear about the timeline here, because hope without a schedule is just wishful thinking. Based on the technical structure of the chart, The most probable scenario has gold working its way down to the 3,900 level sometime in the coming weeks to months, potentially staging a partial bounce from there before eventually completing the retrace to the 3,500 zone. That full retrace, the scene of the crime level, could materialize anywhere from July to the end of this year, and it is possible, depending on how macro events unfold, that it gets pushed further out. If it gets pushed out and gold continues to chop sideways in a consolidation pattern before making its final move lower, that is actually fine. From a long-term structural standpoint, what it would mean is that the entire 2025-2026 period becomes a massive base-building consolidation, and then gold launches from that base into a move that takes it to new all-time highs in 2027. That is the bull case. That is the timeline I am working with. And if I am right, then the investors who bought at 3,500 or below are going to look like absolute geniuses. The investors who averaged in at 4,200 and 4,300 are going to look like they got lucky at best. Now let us move to silver, because silver right now is in some ways an even cleaner, even more dangerous setup than gold. And most people watching this video are probably more exposed to silver than they realize, because silver attracts retail investors the way a bright light attracts moths. And moths that fly too close to the light do not end up in a good place. Here's what the silver chart is showing. Silver recently hit the $82 level, which has been a key resistance level on the chart for months. That is the ceiling. It hit it, and unless it can break through with conviction and hold above it, that $82 level is a wall that the market is telling you is too heavy to break right now. If by some chance silver does manage to punch through $82 with real buying volume, the next target above is $92. But I want to be very direct with you. Based on the overall technical structure of the silver chart, breaking through $82 with enough momentum to reach $92 is not the most probable near-term scenario. The more probable scenario is the one that the chart has been telegraphing with the same brutal clarity that gold has been, showing, look at the silver chart and tell me what you see. High, lower, high, lower, high, low, lower, low, lower, low. That is a textbook descending pattern, and it is not ambiguous. It is not a matter of drawing your lines slightly differently to get a different picture. The trend is down in the near term, full stop. And the only question that matters is how far down. For silver, my answer is this. And I want you to understand that this is not a guess. This is not me throwing darts at a board. This is the level that the technical structure of the chart points to with the kind of precision that justifies patience over impulsive action. The buy zone for silver that I am targeting is $49 to $54. That range represents a retrace back to a major prior support level, the same kind of scene of the crime retrace that I described for gold. And it is a level where I would begin allocating serious capital to silver on a longer term basis. Now, here's something genuinely fascinating about the relationship between gold and silver right now that I think most people are completely missing. Gold has already visited its equivalent support zone multiple times during this pullback phase. It has repeatedly come down and touched those key technical levels, tested them, bounced, and gone through the process of confirming support. Silver has not done that yet. Silver has not done its homework. Silver has not paid its dues at the technical level that corresponds to gold's pattern. And what that tells you, if you understand how these two markets relate to each other, is that silver has more unfinished downside business than gold does right now. Silver is the market that has not yet experienced the flush that completes the technical pattern, which means the flush is still coming, and when it comes, it is going to shock people who were not paying attention. The people paying attention, the people watching this video, the people who know their exact buy level is $49 to $54. Those people are going to be calm. They are going to be ready. They are going to be buyers when everyone else is panicking. That asymmetry of preparation is the entire game. Now let us address platinum and palladium, because these two metals are frequently ignored by retail investors, and that is a mistake. Not because they are about to moon, but because understanding their charts gives you a more complete picture of the overall precious metals complex. Platinum is showing the exact same descending trendline pattern that we've been discussing on gold and silver. High, lower, high, lower, high. The sellers are consistent, they're organized, and they are winning the near-term battle. There's a level on the platinum chart around $1,675 that represents what should be significant support when we get there. That is the dip that corresponds to the October period of last year. And it is the level that the chart has not yet revisited during this pullback. My expectation is that we are going there. I am not hoping for it to hold. I am not assuming the bull market is over. I am simply reading what the chart is telling me about the most probable near-term path. And that path goes down to $1,675 before platinum has any business making a sustained move higher. If platinum fails to hold $1,675, and I want to be transparent about risks because I deal in probabilities, not certainties, then you are looking at $1,500 or potentially sub 1,500 as the next significant support level. It would be a deeper flush, a more aggressive correction, and it would represent a more significant buying opportunity for those with the patience and the capital to wait for it. But even in the base case scenario where $1,675 holds, you are still looking at one more meaningful leg down on platinum before the recovery begins in earnest. Anyone buying platinum right now at current levels is making a bet that the descending channel will suddenly and without warning reverse. And while that is theoretically possible, it is not the bet that the chart supports, and it is not the bet that serious, disciplined capital should be making. Palladium tells a story that is in many ways the most instructive of the four metals, because the technical structure on the palladium chart is almost textbook perfect in its clarity. Look at the long-term chart. You have a series of low pivots that created a massive support base, then palladium broke out of that base and made a significant move higher, but then it came back. And here is the critical detail. It did not come all the way back to retest the support zone from which it broke out. That is unfinished business. That is the scene of the crime, sitting there on the chart, waiting to be revisited. The number I am watching on palladium is $1,235 to $1,240. That is where the major long-term support structure lives. That is where the confluence of prior pivot lows, the broken resistance that became support, and the natural retrace level all converge. When palladium gets to $1,235 to $1,240, I'm going to be watching it with serious intent, because the amount of technical support at that level, years and years of market memory baked into that, the price zone is substantial. It is the kind of level where institutional buyers, the people who actually move these markets, start paying attention. The pattern on palladium tells you another important story about what resistance and support really mean over long time horizons. That key level, the one I just described, was support, then support again, then support again. Then it broke and became resistance, then resistance again, then it almost broke out before finally breaking out convincingly. That is years of market history encoded into a single price level. That level has meaning. It is not an abstraction. It represents real money, real decisions, real battles between buyers and sellers played out over an extended period of time. And now that palladium has broken out from that level and has been trading above it, the most probable next move in the context of the current pullback is a return to that zone. Not a collapse back below it permanently, a test, a retrace, the scene of the crime, and then, assuming a long-term bull case for palladium is intact, a bounce from that level sets up the next leg higher. That is how markets work when they are healthy. That is the pattern I am looking for. Let me leave you with this, and I'm going to be as direct with you as I have been throughout this entire video, because you do not need me to sugarcoat it, and frankly, you do not deserve to have it sugarcoated. You have two choices right now when it comes to precious metals. Choice one, you let your emotions drive your decisions. You buy because gold and silver feel safe. You average down because you cannot admit you might have been wrong on timing. You watch your position turn red and you convince yourself it is just temporary, right up until the moment where you cannot take it anymore. And you sell at the exact bottom, missing the entire recovery that follows. That is the choice most people make, and most people in markets lose money. Choice two, you do what the serious money does. You identify your levels, you write them down. Gold at $3,500, silver at $49 to $54, platinum at $1,675, palladium at $1,235. You put those numbers in your phone, in your notebook, wherever you need to put them, so that you do not forget them when the chaos starts and everyone around you is panicking. And then you wait. You do nothing. You let the market come to you. You do not chase. You do not get impatient. You do not convince yourself that some minor bounce means the flush is over. You wait for your level. And when it arrives, you act with conviction. That is how real wealth is built in these markets. Not with excitement, not with narrative, not with hope, with numbers, discipline, and patience. Subscribe to this channel, share this video with someone who is about to make an expensive mistake in precious metals. And I will see you in the next one.